Good morning, class. Today we're going to be starting chapter number 17, which is the balance sheet. And if you can recall, I kept telling you during the sessions on chapter number 16, which were for the trading and profit and loss account, I kept referring you to chapter number 17 and constantly reiterated the fact that chapter number 16 and 17 will be connected, and we would keep going back and forth between the two chapters because they are related to each other. Now, chapter number 16 was about trading and profit and loss account, where you learned how to calculate gross profit and net profit. Now we're going to resume. So now we're going to learn how to make the balance sheet. And what is a balance sheet? Why is it required? What does it show? All of these things are going to be covered in today's topic. Starting with the definition and content of a balance sheet. The balance sheet is the second most important financial statement of a company. What was the first important financial statement? The trading and profit and loss account, which we already learned in chapter number 16, term 2. Now, this is a statement that basically tells you that what is the financial position of the company in a given point in time. If I can be more specific or simpler, I can tell you that it is simply a depiction of your accounting equation, which was asset equals to liabilities plus capital. And this is the depiction of your accounting equation at a given point in time. So, this is a statement that shows your assets, capital, liabilities of a business at a specified date. In simple terms, it tells you what a business owns and what it owes. So, everything which you have got in the business is coming from two sources of money: your money, what the business owns, and borrowed money, what the business has to give back or what it owes. Now, it is prepared from the remaining balances in the trial balance after the preparation of trading and profit and loss account, which was learned in chapter number 16. If you can go back to question number 16.4, our comments which we did in the class, or GC 17.1 or 17.3, 16.1, 16.2, 16.4, you will see that there were a list of balances in those questions, and we only took those figures which were related to the profit and loss account, and we drew a profit and loss account by using those figures. But the figures which related to the balance sheet, I told you to cancel those out at that point. Now, we are going to refer to the very same questions and start dealing with our balance sheet. Okay. So, next comes the step in the preparation of the balance sheet. What is involved? As you would know by now that there are going to be three classes of accounts which you're going to be dealing with. Now, if you see here, the balance sheet only talks about assets, liabilities, and capital. It means there's going to be no role of expenses, no role of sales, no role of purchases, because all of those things have been covered in your profit and loss account. Now, this is the second part, so we're only dealing with assets, liabilities, and capital. Let's look at this exhibit first, for example. It is an exhibit from B. Swift, who is the owner of the company. I always keep telling you to read the name of the owner, the date of closing date of the business, and what the business is about. So the trial balance is on 31st as at the 31st December 2010. So it means the closing date is 31st December 2010. And they say after the trading and profit and loss accounts have been completed, these are the figures which we are left with. This is why in this list you do not see purchases, sales, expenses, because those have already been taken care of while they've made the profit and loss account earlier. Now, fixtures and fittings are 5,000. Fixtures, I told you, are an asset. Debtors, the people who owe us money, 6,800. Creditors, the people to whom we owe money, 9,100. Stock, 3,000. Bank, 15,100. Cash, 200. And capital, 21,000. Hence the trial balance matches. This is the information available. Now coming to the point where you make a balance sheet out of it. Now students, please pay attention. This is a comprehensive example. Okay, it's going to entail all the classes of assets and liabilities and capital, but which will now not be of any use to you because this exhibit does not have everything inside it. So this format is given for your understanding purposes only. Where there are no figures available, those points will be blank. Let's see the dotted line there. There. Okay. Now we've made 3 columns. Now I told you this is assets. It's going to be a depiction of your assets equals liability plus capital. Now there are 2 kinds of assets: fixed assets and current assets. Fixed assets are the assets which are used for more than 1 year. Okay. Current assets are the assets which can only be used, consumed within 1 year. Now how many fixed assets do we have here? Only one: fixtures and fittings. So we write fixtures and fittings underneath the fixed assets, we write the value. Then the current assets, because they are also assets, but just their life is within a year. Stock. Remember, stock are the things you buy in order to resell. The stock should be consumed within 1 year, that is sold off and made a profit from. So the remaining closing stock is for 3,000. Debtors. Debtors are the people who have to pay us money, so they are our assets, 6,800. Then cash at bank. How much money do we have in our bank account? 15,100. Then cash in hand. What is the cash in hand available? 200. There are 4 current assets available, which we wrote here as a list. Add them up, write the total here. Total of current assets is 25,100. Now, from the current assets, you are going to subtract the current liabilities according to this format. After this, I'm going to share another format with you, where we're going to club together all the assets first and the liabilities together later. Anyways, for now, we are saying current assets less current liabilities. Liabilities are when you owe money to someone, borrowed money. So our liabilities, as indicated in the question, is only one: creditors, that is 9,100. So current assets minus current liabilities 9,100. What are we left with? We are left with 25,100 minus 9,100, 16,000. This is your net current assets. So current assets minus current liabilities gives you net current assets. Why do we say net current assets? Because it is a positive figure. Current assets total is more than current liabilities. Current assets are 25,100. Current liabilities are 9,100. You subtract them, the answer is 16,000. So net current assets. The name of the bigger figure prevails. Now, from 16,100, then what did we do here? So these are our net current assets. These are our fixed assets. Add them together. The total assets are 16,000 plus 5,000, 21,000. Okay. Now let's talk about our liability section. Do we have any long-term liabilities? No. No loans, nothing. So this is it. Our asset side is complete. There was only one liability which we took care of here by subtracting it from the assets, 21,000. Now, if you have already done, girls and boys, if you have already done assets minus liabilities, then the remaining answer should be your capital. This section, financed by, means we are going to be talking about our capital section. In the capital account, how much is the capital brought in by the owner? 21,000. So, here, okay, 20,000. Cash introduced is 20,000. Net profit for the year is 8,000. This information has been given here. Okay, so capital was 20,000. Cash introduced more was 8,000. So total capital became 28,000. Minus drawings 7,000. When the owner takes out the money from the business, we call it drawings. Drawings reduce capital. Hence, subtract drawings, and the remaining answer is 29,000. So your balance sheet balances. Asset side equals capital side. Please take a moment and go over it again. As a classwork, what I want you to do is, please go through it again and try to understand the format given here. Thank you. Bye.